But we start the second half of the day with a block dedicated to goal-based investment. Now, sounds new, sounds complicated. Turns out it isn't really new, and it has found a lot of followers in the institutional space already. Complicated it is, though. We have a speaker who I couldn't think of anyone else who could actually lay the floor or lay the ground for us to understand the topic better before we go into another presentation and a live interview here. And this is Professor Pierre Gaulin-Dufresne. He is Swiss Finance Institute Professor of Finance at the École Polytechnique, sorry, so many languages, it's really complicated, at the École Polytechnique Fédérale de Lausanne, aka EPFL. He has been a CFI Senior Chair since 2011. Previously, Pierre held the chair of business of the Graduate School of Business at Columbia University. He has also spent 4 years at the Quantitative Strategy Group of Goldman Sachs Asset Management. He is a member of the academic advisory boards of Lombard Odier and the US asset manager Kepos Capital. Please.
Well, thank you. It's a pleasure to be here. I'm sure there's many people who could do this better than me, actually, but nevertheless, it's my pleasure to tell you about goal-based investment. So I guess my role is to give you an academic perspective on what this is. So if I can switch, it's not the right one? No? Aha, here we go. So, what I'll try to do is first give you some background. What exactly is it, a definition, and then is it new? If not, why are we focusing so much on it currently? And then what I'll do is I'll give you some perspective on how goal-based investment actually changes the way that you would take an allocation decision. And I'll rely on two examples. One is a paper that I wrote with two co-authors, Bob Goldstein and Benzoni, that was published in 2007 in the JF. That's about long-run endowment risk, how this changes your asset allocation decision. And another one is some work I did for the Norwegian government, for the Sovereign Wealth Fund, in thinking about their investment decisions. And then I'll tell you about some of the challenges that I think are there when you try to apply a goal-based investment. So, what is goal-based investment? In a nutshell, it's best defined relative to traditional investment. I think traditional investment is an investment manager tries to achieve the highest return based on some performance metric, maybe the highest Sharpe ratio, maybe the highest absolute return, maybe the largest alpha. All right. So the point of the traditional investment is you're trying to maximize return in some metric, but it's a one-size-fits-all. You're not actually thinking about your client. You're just trying to get the best performance for everyone. As opposed to that, goal-based investing is really trying to tailor your investment performance to the specific needs of your clients. So just a few examples to illustrate that. One client might be a university endowment. Clearly, a university endowment will have many inflows coming from alumni, and whether you're at Stanford or Harvard, the profile of the incoming flows are going to be very different. Stanford is probably going to be more correlated with the startup business, and Harvard will be a different type of return. Now, the university also has planned expenses. Clearly, they want to maintain some businesses. They want to pay their faculty, so they have known expenses. Sovereign Wealth Fund might have resources tied to particular natural resources. If we think of the Norwegian Sovereign Wealth Fund, clearly their endowment is tied to oil reserves, so it's going to be highly correlated with the oil market. And they will have some planned expenses. Maybe they have to contribute to some infrastructure project, to some particular fraction of the government's budget. And then they might also have some specific desire to commit to be socially responsible. And if we think of a household, obviously households have planned expenses. They want to maybe finance the tuition of 1 or 2 kids. One kid maybe want to study in the US, so you have some currency exposure there. And obviously the income is a function of the labor income of the household, which is going to be very different whether you're a finance professor employed by the Swiss state or whether you work for a startup. And so, of course, when you start to try to think about these different elements and include them in your investment decision, this will have incidences for how you should propose your investment allocation to your various clients. Now, is this new? I found this really nice paper from Fisher Black in 1976, where he was already trying to contrast how we should invest, whether we are an individual, an endowment, or a pension fund. And he himself was pointing out in his paper this was nothing new, and had this wonderful picture from a 1964 newspaper showing that, you know, thinking about your client's goals has been a long way has preoccupied investors. And I found this other nice paper in 1978 by a then young OR PhD student, Grinold, who you probably all recognize as a very successful BGI investor today, right, who was thinking about how to optimally allocate an university endowment fund to meet the long-range goals of the university. And we have lots of very famous people that have thought about various ways to take into account either labor income or planned expenses in the decision, in the optimal decision and portfolio allocation decision. One thing that you might notice is that even though these papers are very old, the people I mentioned, Fisher Black, you know, Grinold, Merton, Leland, are all people that have been very academics that have then turned out being very successful investors later on. So, you know, maybe these academics were ahead of the curve and they actually put this to some fruition. So it's not new, but why does it become so popular right now? Why do we all think about how to implement goal-based investment? I think it has sort of three main reasons that I could think of, two that are structural, and one that's more conjunctural. The first one is that, you know, since the crisis, I think for banks, the activity in derivatives business has come down, regulatory constraints have increased, and also in general, active investment has not really been convincing, right? The search for alpha or demonstrate active alpha, at least the evidence doesn't seem very strong. Certainly the alpha doesn't seem very persistent, so it's hard for clients to ex ante be able to sort active fund managers, especially if we focus, for example, on US data, which I know best. It's hard to figure out ex ante who are the persistently performing active managements. So that has led, of course, to a move towards indexing and, of course, a downward pressure on fees. And finally, the recent financial crisis has really highlighted, and there have been very, very stark examples of how not taking into account goals and missing goals can have very bad implications for your clients. So think of the Harvard endowment crisis, where because of the famous Yale model, they were invested in a lot of illiquid investments, and as a result of the crisis, took a very hard hit and had to actually curtail some planned expansions, you know, even lay off some employees. Or if you think about US households that got hit by a double whammy of housing and financial shock, and a lot of them had to go back to work, to the labor market at the worst possible time. So clearly, I think because of these three reasons, you know, bankers and financial institutions are putting more emphasis on goal-based investment. And so, question is, how can let me give you an example of how goal-based investment would actually change your investment decision. So let's take the example of the Norwegian Sovereign Wealth Fund. Until recently, the Norwegian Sovereign Wealth Fund had a target in their financial portfolio of a 60-40 allocation, 60 to stocks, 40 to bonds, and they had a 4% annual consumption rule. And so you might ask, well, when is this optimal? Can this be the outcome of an optimal portfolio decision? The answer is, if we look to the old classic Merton-Samuelson portfolio choice, yes, there are some really quite reasonable assumptions under which a 60-40 allocation rule and a 4% consumption rule would be optimal. In a nutshell, you roughly need a risk aversion of 4, and you need a Sharpe ratio on the stock market of roughly 40%, volatility of 15%, and then your optimal investment fraction of your portfolio that you should invest in stocks according to the Merton-Samuelson rule is roughly 60% to stocks. So 40% Sharpe ratio, 15% volatilities are reasonable, historical numbers for the US stock market, and a risk aversion of 4 sounds reasonable as well. But importantly, this 60-40 rule has very strong implicit assumption. It implicitly assumes that the investor has no particular future endowment coming to it, and it assumes that this investor has no particular consumption commitments or planned outlays. So let's think about how changing this assumption on no future endowment and no planned expenditure outlays will change the 60-40 allocation decision. Let's start with future endowment. So if we think of the Sovereign Wealth Fund, it actually has currently, of course, still a lot of future income coming to it from its oil reserves. And we know that roughly half, a bit less than half, is actually still in terms of future incoming oil reserves in the ground. So how does having future labor income or future endowments coming to you as an investor change your 60-40 allocation in your financial portfolio? Well, the main idea, quite simply, is that the 60-40, if it was optimal for somebody who has no endowment, remains optimal for somebody who has an endowment, but what should be optimal is to allocate 60-40 of your total wealth, i.e. of your financial wealth plus the present value of your future endowment. So if you have now a large fraction of your wealth, maybe half, coming from the present value of your future income, how does this change how much you should allocate to stocks in your financial component? Well, that's going to depend a lot on what is the nature of that future income. And in particular, to make it simple, whether it's bond-like or stock-like. Let's see how. Well, suppose very simply that you have 50% of your wealth in current financial wealth, 50% is the present value of your future income. Okay? And suppose 60-40 would be optimal for somebody without income. Now, if that 50% from your future labor income is entirely bond-like, i.e. it's risk-free, what does it mean? It means that without doing anything, you already have a 50, even if you invested 100% of your financial wealth in the stock, you'd be 50-50, right? Because you already have 50% of your wealth in risk-free labor income. If you invest 100% of your financial portfolio in stocks, you're 50-50. But you want to be 60-40. That means that actually you need to invest more than 100% in your financial portfolio in the stock. In this particular example, you need to have 120% in the stock so that for your overall wealth, you're 60-40. Right? That means effectively you need to borrow against your future labor income to increase your allocation to the stock market. Now, of course, suppose, on the other hand, that your future labor income was actually 100% stock-like, i.e. your future labor income flows are perfectly correlated with the stock market. That means that without doing anything, even if you invested all your wealth in risk-free assets, you'd be 50-50. Okay? So that means that to be 60-40, you only need to invest a small fraction of your financial assets into the stock. In this case, you need to invest 20% of your financial assets so that your overall allocation, given that your 50% labor income is already stock-like, so that you're 60% invested in the stock market. So that gives you the sense how sensitive your allocation and your financial wealth is going to be to the particular nature of your labor income. Of course, in reality, it's never going to be 100% bond-like or 100% stock-like. It's going to be somewhere in the middle. There might be some correlation some long-run correlation between your labor income and the stock market. And this is sort of the problems we solved in this JF paper that I mentioned. And so what happens then? If you have this long-term correlation, I think of a household, typically over the short run, your labor income contract is fixed. So you're going to receive a fixed income no matter what happens to the stock market. But of course, over the long run, if the economy really does poorly, there's a higher chance you might get laid off. So over the long run, you face this higher correlation that you may not face over the short run. Well, it turns out in that case, your allocation becomes hump-shaped, as we showed. So the red line here would be your allocation at a household level as a function of your age. So 20, you're very young. 55, you're very old. And the optimal allocation, if there's some long-term co-integration, so long-term correlation between your labor income and the stock market, should be to, as you're young, not invest at all in the stock market. In fact, you would like to short, but you can't really short the stock market against your labor income. Why? Because when you're young, you have this extremely high exposure to the long-run performance of the stock market. So your income is really stock-like. But as you age, the time to co-integration, correlation time decreases, and if correlation has less time to act, your income becomes more and more bond-like, and that means you want to increase your allocation to the stock market. And as you become quite old and close to retirement, now there's no correlation anymore between the stock market and your labor income over that short time period. And now the only effect is the maturity effect, which means that as you age, you have less and less income coming to you from labor, and that means you want to reduce your allocation in the stock market. You can see an implication for your allocation decision that's very different from the traditional allocation decision, which just says 100 minus age. 100 minus age being this rough idea that if your income is bond-like, you want to invest a lot more in the stock market when you're young than when you're old. Right? So you can see that the nature of your labor income is very important to determine your life cycle asset allocation if you do goal-based investment. And of course, this particular line is here for one benchmark calibration. It's going to be very sensitive to many things. For example, it's going to be sensitive to the nature of that correlation. If, again, you're like me, you're an employee of the Swiss state, your income is bond-like, so there's no long-term co-integration or a very small amount of co-integration, then maybe you want to be close to the classic investment rule. So depending on the nature of the correlation, this is going to change a lot your profile. Or depending on your investment return. If you are able to achieve a high investment return in your overall portfolio for your investor, this will also affect your investment decisions. And of course, depending on risk aversion, if your investor is very risk averse or less risk averse, it's going to change their investment decision. So what are the insights from this? The insight from this is that when you do goal-based investment, you need to be really smart and know a lot about your client. You need to know about their risk attitudes. You need to know about the profile of their lifetime income. And you need to, of course, then give them an investment allocation decision or recommendation that's tailored to their needs. The last point I want to make on this slide is that the fact that you're doing goal-based investment doesn't mean that you don't do traditional investment anymore, right? It still matters that you're able to get a higher return. If you're able to get a higher return to your investor in the first place, your investor is going to be better off. So it's really classical investment plus thinking about the liability side of the investment that's tailored to the needs of your client. Now, going back to the Norwegian sovereign wealth fund, how do these insights affect how you would recommend they should invest in their investment side of their portfolio? Well, as we said, they have almost 40% that's coming from future endowment, that's coming from oil reserves. That means that their future income is highly correlated with the oil market. And because oil market prices tend to correlate with the stock market, they already have a stock exposure through that. So that means that you already, when you think of their allocation in their equity side, should think about the implicit equity exposure they have to this oil inflows, and of course the very strong exposure they have to the oil market. Which means probably that in their benchmark allocation, they should be lower than 60-40 in the stock because they already have exposure to the stock market through oil. And they should probably, when designing their benchmark, cut the exposure to the oil sector and increase exposure to some things like renewable energy sectors to hedge the component of the oil exposure they have to their labor, through their future endowment flows. Right? Of course, ideally, they would maybe hedge it directly in the forward market, but that's fairly short term, and given their size, they would have huge price impact. So it's much easier for them to target a benchmark allocation on their equity portfolio. So you can see that they ought to think very specifically about the design of this benchmark investment. So this is how an endowment risk, the fact that you're going to receive future labor income in the future, and its statistical correlation with the market would affect your investment decisions. How about if you have specific outlays, consumption desires or goals? How would that change your decision? So going back to old papers by Leland and Cox and by others, there's a very simple way of thinking about this. So if you're a university and you know that you want to finance a particular building in the future, you absolutely want to meet that investment, then you should really divide your wealth into two components. One component which is going to be the investment component, one component which is going to be the liability management component. And really the way to think about it is we should do traditional investment, find the best possible investment portfolio, and then invest in that portfolio, and then take some amount of our wealth to manage and to buy a put option on that investment portfolio with a strike equal to the planned outlays. So our investment strategy effectively is essentially always a fraction of our wealth is invested in the optimal traditional investment portfolio, and the remaining fraction is a portfolio of puts that manages our liabilities. Now, of course, we can't always buy a put on the particular investment portfolio we've chosen. And for sure, we can't buy it at the horizons that the university, for example, will be interested in. But then what we can do is try to do some dynamic asset replication of the put by taking and changing our exposure to the investment portfolio dynamically as the market conditions change. And the insight is very clear, is that as our investment performance unfortunately, suppose we're going to drop towards the present value of the planned outlays, we need to cut our risk in a classic sort of portfolio insurance type management style to be able to increase the probability that we're going to be able to meet the target we're aiming for, right? So it's the classic insights from Cox and Leland. So if we think about the sovereign wealth fund, for example, the Norwegian sovereign wealth fund, well, we can see that they clearly have some very clear long-term commitment to the Norwegian government. Sometimes they have specific infrastructure project that the government might want to fund. So they would be much better off thinking very explicitly about these liabilities that the government wants to meet with their investment performance, and then targeting the risk dynamically in their investment portfolio so that they can then reduce risk if they might be in a position of missing these targeted outlays. So this is in a nutshell how the goal-based investment would change your investment decisions. Now, how would it change your investment process? I think one of the reasons we also see more and more interest today in this particular approach to managing is also that I think the new technologies may help us where in the past the challenges were really very hard. Because as you can see, to do properly goal-based investment, you need to know a lot of information about your clients. You need to know something about their own labor income. You need to know something about their overall wealth. it is not helpful to know only about a fraction of an investor's position in the stock market if he already has some exposure somewhere else through various houses or various other investments. So to be able to do a proper life cycle investment allocation proposal to your clients, you really need to know a lot about their overall sources of revenues. You need to know about their family members, if they have particular goals for their kids. So as you can see, that requires a level of connection to your clients that's not easy to get, right? You need to elicit information on their risk attitudes. We already are all trying to do that. I know that most banks have various ways to try to address this. I think modern technologies here can probably help us a lot with various APIs, with various automated ways of asking questions and having them answer them, having your clients answer them. I think another degree of challenges is to estimate the various parameters. So it's one thing to just think about the investment performance, but if now for every client I need to know about their labor income profile and then estimate the degree of exposure they already have to various asset classes through their future endowments, right? You can see that's a difficult process to put it in place. And then, of course, there's a tailored portfolio construction and trading decision. How do we automate this if we have thousands of clients? How do we have a tailor-made portfolio construction and efficient trading for all these clients? So I think, again, those are the big challenges, right? Getting the knowledge of all these various pieces to propose the right decision, and then doing the modeling, doing the trading for all these different clients in a tailor-made fashion. And I think this is probably also why there's this growing interest today, because with this, these fintech technologies and various digitalization, there might be a chance that we can do this in a more effective way. For example, I think the fact that we can use a lot of these new digital technologies for them to propose to guarantee anonymity is certainly something that's going to be helpful to many clients. So if they can report to you data from various sources in a way that you can guarantee that it's, as soon as it hits your service, is going to be anonymous, I think that's something that might make some clients more comfortable. And then obviously using advisor robots for clients that are below a certain size to be able to aggregate information and make proposals without having to be face-to-face with all of them might be helpful. So I think these are the challenges that I see, and these are mighty challenges. But on the other hand, I think that the new technologies that we're having currently and this discussion of fintech might actually be helpful in surmounting some of these challenges. So just to conclude, I want to say that I think goal-based investment is not really something new. It's also not something that is orthogonal to traditional investment. Actually, you still need to offer the best possible investment return to your client. But in addition, right, goal-based investment forces you to think about how the future endowment and resources of your clients and their future goals, their particular specific expenditures, right, could help you tailor their portfolio's performance to their needs. So it's really classic economics. But I think we are at a time where this might be the right thing to think about. We have new technologies that might help you surmount some of those challenges. I think it's also a source of potential fees for you, and if you can leverage these technologies to propose individualized, tailor-made investment strategies to individual households, high net worth individuals, sovereign wealth funds, and endowments. I think this might have some really promising, this may be some promising future business opportunities. Close here. Thank you.
Thank you very much. Thank you very much. Really a fantastic presentation. Really laid the floor for what is happening now. So for the second part, technology has key, and Professor Colin Dufresne has laid that out. Technology is key, but also an enabler to introduce this goal-based investment model. So we have next up is an impulse speech by Matthias Wies of the Swiss Quant Group. He's head of product development of that particular group. He will explain why the concept is the ultimate benchmark for investors and how this kind of investment is more simple due to technology. Thank you.
Well, thank you very much, and welcome from my side as well. Thank you, Pierre, for the really excellent introduction. So I don't need to show any formulas today, because all the theoretical part has already been covered. It's really at the ground of what we did at Swissquant Group. Today, I'd like to introduce you a little bit to an applied version of this concept of goal-based investing. And the way we've tackled it is in an innovation partnership with TKB, and David Strebel, who is going to be in the interview afterwards, is going to talk a little bit more, hopefully, about how we tackled this. But it's actually a really applied way of goal-based investing to the investment advice process. And here, of course, we're in the private banking space, wealth advisory. So I'd like to show you how this fits into that part, how we bring asset liability management to private investors. Exactly the points that Pierre raised. How do I achieve my consumption goals? How do I meet my liabilities? And how do I optimally steer my risk level in my asset allocation to achieve these goals? And this is really a tool we built together, and I'd like to also give you a little bit of a demo. So the theoretical part is behind us, so we can really focus now on some applied work. So of course, we all have investment objectives, we all have goals in our lives, but as even Antoine de Saint-Exupéry stated, a goal without a plan is just a wish, right? So we need to have a clear plan how to achieve these goals. And that's where we come in with a strategic tool that really helps the clients to get to the goal and to maximize the probability of achieving the goals. But of course, traditional financial advice is centered around things that are a bit difficult to understand for the end client, right? You know, you're all investment professionals. To you, all these numbers, you know, you're very familiar with risk metrics, with target ratios, target risk levels, etc. But to the traditional investor, that doesn't really matter so much. What matters to the traditional investor is how can I really meet my goals? And that's really the client-centric benchmark. So what we want to achieve is that, of course, we have complex algorithms behind, but the front, the presentation and communication layer to the end client and investor is based on a benchmark that matters to the client. How do I achieve my life goals? And hopefully, the financial advisor or the bank will help them to get there. So this introduces this new concept of what we call holistic goal-based wealth management. And the key idea is really to enable customized advice, how Pierre brought it up. Thanks to technology, we can really bring tailored advice to the end client, so tailored portfolios that maximize the probability of achieving the client's goals, really always around this overarching benchmark of client goals, and being on an intuitive communication layer with the client as well, rather than talking about how did we out or underperform the S&P 500 or the SMI in the last month. We talk about what's the probability of achieving my goal? Am I still on track? Is everything still fine? Or do I need to do something? And finally, we can also use such tools to have clear expectations management. Is it really realistic with my current wealth, my current future income, and my future planned expenses to achieve these goals? Or do I need to change something about my investment strategy? Where does this fit into the whole robo discussion and automated advice? Where we see it between the traditional model of the wealth manager-led manual processes and the fully automated, simplistic robo-advisory models, we see it as the hybrid approach in the middle, combining human relationships, which are important to really get the client to tell us about his life goals, to find out more about what he wants to achieve, but at the same time have very, very sophisticated algorithm in the background, which do the number crunching exactly based on the models that were described before to find out what the optimal risk level is to achieve these goals. Furthermore, where does it sort of fit into the advisory process? Or honestly, where did we put it, position it within the advisory process? So Swissquant does a lot of other things apart from goal-based wealth management. For example, the whole wealth advisory process in a digital fashion. And where we positioned it is really in the risk profiling. So what's the optimal level of risk given your goals and given your financial circumstances to achieve and maximize the probability of get there? The good thing about this is then that you can implement this strategy in different levels. So in an advisory mandate, in a discretionary mandate, or even a full robo-advice mandate. So that part is just the implementation layer. But the goal-based wealth management comes right at the beginning, where we know about the financial circumstance of the client and what he wants to achieve. But before talking a lot more about on slides, let me show you the actual tool and how we built the use case now around something similar that has been mentioned before, like a housing target. So I have a family, I have some savings income, and my kids go to university in a couple of years, so I need to definitely finance that for sure. But at the same time, it would be nice to have this little holiday house in Marbella that I've been dreaming about for a long time. And how do I invest best my funds today to achieve this goal? So we start off with the overall wealth overview. So currently I have 1.6 million in total wealth, consisting of different accounts here at my bank. What's of course important is that this is the actual market value of my invested assets as well. I might even have some other assets with other banks, which I can then include. Of course, it's very important to have the holistic picture and see what's my total wealth. If I have other assets, I need to consider this in the picture. And maybe there's some part which I don't want to take into consideration for now. But of course, it's also important what are my future liabilities and cash flows, right, coming in. So of course, I have some savings, luckily, which I plan thanks to my labor income. I can save 2,000 francs a month for the next 15 years until my retirement. And that has to be taken into account in my asset allocation choice today. How much risk can I take today, given that there's going to be some cash flows coming in? But of course, as I mentioned to you, it's very important to also consider what I definitely need to finance, like my children's education. That's a given. So they're going to university in a couple of years' time. I think in this case, it's in 4 years' time, and they're going to be studying for 5 years. So that I want to have financed for sure. That's a certain cash outflow that I need to take into my investment decision. So I have a tool here which allows me to capture all these cash flows and to have a complete view of my current wealth and my future liabilities and cash flows coming in. But of course, now the interesting question is, yes, I want my bank to help me achieve my dreams, achieve my goals. So now I have this dashboard which helps me to find out, what are my goals that I want to track with my bank. And as I said, I'd like to finance my holiday house in Marbella. It's going to cost me about 500,000 francs. And ideally, when my kids finally go to university, then in 10 years' time, I can, or 8 years' time here, buy this house. It's going to, and of course, I can also steer the importance here. To me, that's personally a high important goal. So now I have a dashboard where I see my current wealth and my target. But now I need to simulate, is that even realistic? How do I get there? And how do I best invest today to maximize the probability of achieving this goal? And now we go into the simulation mode. Of course, I need to allocate some of my funds to this goal. Let's start off and say, well, 400K to this goal, where does this get me? And here I have the choice of all the investment products that the bank offers me. And here we took the different risk profiles that the bank offers me. And now our dynamic goal-based algorithm calculated the probability, how realistic it is to achieve this goal, and a dynamic investment policy, which tells me how to optimally diversify risk over time to best achieve my goal. I can see also scenario paths. Of course, it's not 100% certain that I achieve the goal. So I also show the client some scenarios where I don't achieve the goal, because that's realistic. I don't have 100% certainty. And here are the different investment strategies that the algorithm dynamically chooses from over time to, at any point in time, maximize the probability of achieving the goal. And maybe we can stop it there. I don't know if you can, you don't have that function. We tested it before quickly. But let's have just quickly the idea again. So this is now how I have dynamically the possibility to achieving my goal with different investment strategies. But now I want to cap my risk. I want to say, well, the maximum risk I want to take is a balanced strategy. Of course, that hurts my expected returns, but at the same time, I'm sure that I will never go above the balanced risk profiles. However, it's not enough probability given my high importance, so I let the algorithm tell me what I can do now. So the algorithm recommends me, for example, just invest a bit more of your current wealth into this goal and allocate 30K more, and you're going to be back on track out of today's view to maximize the probability of achieving your goal. So the intuition is clear. We have a realistic goal, and we can track it over time and monitor it, of course. So when the market moves, when things change, we'll get an alert to reallocate. So now here I have my existing funds in my portfolio, which now were first represented just in terms of market value. Now I actually take some specific assets or even partially a fund here that I already have, allocate them to the goal, and make sure that I have the optimal level of risk to achieve these goals. The second step, as I told you now, is just the implementation layer. How do I want to work with the bank going forward to achieve this goal? Do I want to go into an advisory mandate, or do I just want to have the bank take care of the rebalancing in the future and just inform me if something is off? So here, it's just a few more clicks. I have the goal implemented, and going forward, I will have this as an active goal, tracked with some assets linked to it, and an investment strategy that at any time going forward, with this dynamic replication strategy that we heard before, tries to maximize the probability of achieving the goal. So it's a very, very simple process for the client advisor to focus on something which really, really matters to the client, achieving his lifetime goals, rather than, asking the bank, did we out or underperform 10 or 20 bips last year, right? And of course, also for the bank, it's very important because we move from a manual, time-consuming process to an automated, efficient investment process. So the fintech the technology that Pierre mentioned before is here already to make sure that we have customized, client-centric, and tailored investment advice. Of course, that covers a large range of different investment products and makes the client and the bank more productive. So let's summarize. In terms of the client, what's in it for him? Focus on client goals as the ultimate intuitive benchmark. Hopefully improved client satisfaction and expectations management. And of course, also for the bank, it matters, because what do we do with all the cash that the clients have laying on their bank accounts? We want to get it invested. We don't want to pay the SMB and Bürkleblatt 75 pips per year. So we want to incentivize the client and show them that it matters, that it's worth it to get the cash invested. And as a second part, was very, very important, is that risk becomes an integral part in goal achievement. It's not something we just want to minimize. We directly see the relationship of risk-taking onto goal achievement probability. And hopefully, we can also bind the client into a longer-term relationship, because we don't yearly have this discussion on what was the performance relative to our peers, etc., because it just matters whether I'm still on track to achieve my goals. So this is very much how we applied goal-based wealth management in the private wealth sector. But of course, here we have a lot of asset managers. So that's where it comes in, where it's also important to asset managers. And that, I think, is interestingly now the academic feedback loop, where ALM has been around and goal-based investing has been around for asset managers, asset management for decades, is becoming more popular now thanks to technology and applications for the private investors as well. But we have recent research that also shows now how important it is becoming for pension funds nowadays to also have dynamic strategies over time with the goals of meeting their long-term obligations. And the theory now suggests that we should move away from a zero-bond, risk-free discounting approach to these type of dynamic goal-based replicating strategies that could help us solve the zero interest rate problem that we have nowadays for the pension funds. So with that final remark, I'd like to close. Hopefully I can tell you a little bit more about Swissquant in the break. We're the largest independent fintech in Switzerland, close to 90 quants based here in Zurich. The dots are unfortunately not our offices yet, but we have clients all over the world. And with that, I'd like to close and thank you.
Thank you very much. We've had... Is okay? Is okay? We mag het zo niet. Is okay. Is okay. We mag het zo niet. Thank you very much. We've heard from the system provider, Mr. Strebel. Hello. Hello. We have heard from the system providers, and now we want to hear from the guy who actually takes the responsibility to introduce this concept to his bank. So this is David Strebel. He's head of market services and executive board member of the Thurgauer Kantonalbank, and we are now having a discussion about this concept. So I guess the first question for me would be, why? Why do you take the enormous amount of work and try to implement something new? Why is it helpful for your clients?
Well, there have been a lot of things already said on how important it is to take into account the future of financial spendings and plans. And especially for a retail bank like ours, who is mainly serving retail affluent clients and maybe also high net worth clients on the lower end, I think the typical financial challenges they have requires a financial plan before even talking about investment at all or what kind of investment should be done. So this is the basic, and we are doing this. We have been doing this for quite some time, but the problem was, as I think very well explained, is to have a link between financial plans and then what does that actually mean for your asset allocation? And we were looking for a solution for quite some time, because to tie traditional asset allocation, traditional risk profiling, and kind of aim to satisfy client goals, to address explicit goals, doesn't work. It simply doesn't work, and that's my guess why it hasn't been introduced or already ground in our industry, in private banking and retail banking. And, well, someone has to start with. And this is our approach to differentiate ourselves, because we really strongly believe that this is the future, not only for pension funds, endowment, for state funds, but especially also for retail and affluent investors.
We have to be transparent. You wanted to be live already.
Yes.
There were some delays. Can you say what were those delays about? Was it about the concept?
Well, it's an innovation. So you take new grounds, and obviously usually you are too optimistic. You have your plans. Well, I would say these are the normal delays that you have according to initial plan, good intentions. We have technical problems. Of course, we need to have it properly integrated into our system. We don't want to have just a profiling tool. We want to have it integrated to our processes. Documentation is important, monitoring of portfolios, implementation, everything automated. So this is quite a bunch of things that need to be done, and we should not underestimate the challenges. We are quite close to get live in the next couple of weeks.
Next couple of weeks, okay.
Yes.
So let's July.
Well, let's say after summer holidays. That's probably more realistic.
That's good. When we speak about the clients, and we have seen a live demonstration of the tool there, how many goals can they set at the same time, and how many goals does it make to define for oneself?
Well, theoretically, there can be an unlimited number of goals, but in practice, we assume there will be probably between 1 to 4, realistically. Typically, for an affluent client, maybe some financing goals, education of kids, and then provision for retirement. That is the typical, let's say, the typical portfolio of goals client might have. Of course, in the private banking space, clients tend to be a bit elder and older, and there the plan that we guess, or what we believe is one thing is preservation, capital preservation for later generations. So preservation, keep the capital within the family. And the other thing is, of course, provision for medical care. That's also, I think, an obvious goal many clients have.
And this will be open-ended goals, like medical costs to cover, for example?
Well, that brings in advisor, because these are really practical questions of life. So, of course, it's not only or anymore which fund to choose and select the right equities and bonds. It's really the advisor has another role. When we talk about Gamma, it's more given advice to develop an individual plan. Of course, it requires good knowledge about things like pension, medical care, all those things that matters in life. I don't think it would be credible for us to have a value proposition telling clients, well, we will create alpha. That is certainly not credible, but I think it's credible when we claim we are advisors, financial advisors that can help clients navigate through their financial challenges.
Now, we've heard before, you need an awful lot of data from your clients. I mean, data, they speak to you, they give you targets, they give you labor income or other income. Do you think, will they be open enough to give you all of the information?
Honestly, for upper affluent, we already know it in most of the cases because we do financial wealth planning. But important, in contrast maybe to the big-sized funds, we need to make it really kind of reduce it and make it simple, also in order to have a short process that is also applicable to smaller clients in the retail segment. So this is, of course, an important element. The thing is, I think, that we don't make the whole story too big, that we can also start with fraction. It doesn't mean that a client and his entire financial situation needs to be addressed immediately. You can start, you can keep your things running and start with one specific goal. For example, save for your gap in your pension plan. Just a simple saving plan to see how it works. For that, it's very isolated, and I think what differentiates us from maybe other approaches you can use GBI is that we build segregated portfolios per goal. From a behavioral perspective, we are convinced this is the better way because clients will see, okay, this part of my wealth is dedicated to that goal, another goal, and we can measure probability of achieving goals for each segregated portfolio. We can monitor it. We also have, I think, from a regulatory perspective, better conditions to really have this required transparency.
Now, I have to take the client's perspective and I ask myself, why is this approach better for me than the other? Because in the end, let's be honest, or at least I'm honest, I'd say the S&P has done like 10% last year. No, last year was much more, but anyway, it has done 10%. I want to know how much you made as a bank for me.
Well, this is exactly the thinking that this is, of course, short-term, it's relevant. But actually, Sharpe ratios, these are not, I mean, you can buy a product that has an excellent Sharpe ratios and still miss your goal. That's the point. And I think you can, if a client is prepared to share his goals with you and also able to quantify it, then in return, what the client gets is first, of course, a bespoke solution compared to a standard portfolio balanced usually. You get a specific rebalancing input, specific to rebalance to optimize or to maximize your probability of success. compared to a naive rebalancing that is usually applied in the industry. And third, not to underestimate, is the coaching in stress times. If we know what the goal is, I think we can much better coach a client to do the right things when it really matters. The thing is, we all know from there is enough evidence that you determine your long-term performance by behaving correctly in stress times. And the problem of the traditional approach is there is no reference point somehow. With goal-based, you have a goal in the future. By definition, it's in the future. And I think that is the right reference when it comes to stress and talking about what is a good thing to do. There are studies, unfortunately not for Europe, but there are concepts like Morningstar Alpha or Vanguard's Advisor Alpha, these kind of concepts, and they claim, well, 100 to maybe 250 basis points over long-term additional value that can be created through advice. And then, of course, you have a justification for the advisory fee that all banks are struggling to implement.
Yeah. So how would a model react after a sell-off phase? So that sounds to me that you would actually have to increase the risk in the portfolio to buy more equities, for example. Is that what the model would suggest? And have the clients
under certain circumstances, yeah. I mean, typically in a market sell-off, what will happen? Risk premium soars, and your wealth drops. Okay, so I think that it's obvious, and that is, we haven't seen it due to time, but what the model would tell you is to increase risk if you can, if you remain in your risk spectrum, in order to keep the probability as high as possible to still achieve the goal. A traditional behavior would be, well, you just rebalance your portfolio and bring it back to the risk level that you had before. This is how it does. So it's a naive rebalancing compared to a very specific. But also, on the other hand, if you had an exceptionally good performance period and you get unexpectedly quickly to your investment goal, then of course the model tells you you can afford to reduce the risk because it's no longer necessary to run the same amount of risk to achieve the goal. And I think that is the main principle then that traditionally with risk profiling banks do. They tell you, they try to figure out how much risk you can take, and then they incentivize you to always take that amount of risk, whereas GBI suggests that you always take the necessary amount of risk to get to your goal. And this is we believe that this is what clients want. They don't want risk. They just are ready to take risk in order to get something they want.
Now, how do you set the actual portfolio? I mean, we've seen the strategies per se, but how is it really done, and sort of what can you tell clients where their money is actually invested in?
There are different solutions. I mean, that's part of the simplification for private investors. So we do bespoke plans, a dynamic path, where we show in what strategy you need to be, depending on time left, your level of wealth, your risk spectrum is, and of course the capital you invest and the target is. That's the kind of the framework you work in. Afterwards, when it comes to implementation, underneath that pattern of the dynamic path, there are strategies. Matthias Wies talked about it. And of course, then you enter into the traditional way of portfolio management. You try to optimize, you get an optimal portfolio given the expectations you have. So implementation then is rather traditional. It leaves room for specific or individual needs or priorities, or if an advisor or client thinks they have specific skills in selection skills, okay, they can do that. Important is that they stick as close as possible to the strategy in order to make the plan work. Otherwise, it's not reliable anymore.
But would I be wrong in assuming that most of the products you use for those strategies are passive?
Ideally, of course, they mirror the product that you use, mirror the characteristics of the strategy. So, yeah, typically there would be index funds or these kind of things. But as I said, I mean, if they're good products, or you believe you have particular selection skills, the concept does not exclude this. You need just to be aware a bit that you probably divert a bit from the kind of the ideal or the optimal portfolio, which is also kind of somehow still theoretical.
Yeah. Yeah. So how do you go about teaching your relationship managers? I mean, it's quite a concept. It's something new. They have to explain it to their clients. How do you go about this?
That is, we believe, or from what we have seen so far, we believe the challenge is bigger in private banking than in affluent, surprisingly. The thing is, in private banking, there have been traditions for decades. People were doing this the same all the time for years. So to bring them back, kind of bring them away from generic goals to specific goals, that is a challenge. So there is, to persuade people on the private banking side, we talk a lot about goals. Because if a private banker understands that the power of goals, quantifiable goals, then I think the rest is quite intuitive. Because how the dynamic path reacts to different parameters changing, I think that is quite intuitive, actually. In affluent, I think there that the challenge is more how to do it in an advisory talk, how to apply technology, how to explain things, how to make it easy, etc. I think there, don't bother too much about all those technicals behind the scenes. Yeah. It will take years. It's a cultural thing, but you have to start once.
Absolutely. Just a personal question: do you invest according to this?
Well,
concept?
As soon as I can, I do. I do on my way. Yes,
yeah.
Of course. I think it's. I mean, simply, it's a general rule. Eh? People with goals take better decisions and are, as a rule, more successful because they have a compass and they just take better decisions. If you're a bit ambiguous all the time, I think that is the problem of many investors and people in general. So yeah, I have my plan, and I learned with that to be more disciplined, and I think that will be another contribution to that.
Fantastic. Thank you very much, David Strebel.
Thank you.
Now we have time for questions, and I would like to have Matthias Wies on the stage as well, and Pierre Collin-Dufresne as well. So ask all the questions you want. No questions, really? Oh, Entschuldigung. If you could state your name and affiliation.
Yeah, my name is Patrick Stauffer. I'm from BWM. I would be very curious about the pricing models you attach to these new strategies.
To whom you want to pose the question?
Anyone.
Okay.
Well, we are public. You can anyway. You can see that on our website. We don't apply a particular pricing on that. It's part of our advisory process. Our pricing differs whether you invest afterwards in a discretionary solution or in an advisory solution. Very classical. We have depot. We call it depot. This has nothing to do. We don't give advice, so GBI will not be part of this. This is self-guided business. But in the advisory space, whether it is afterwards portfolio advice, or continuous portfolio advice, monitoring, or they put in a discretionary mandates, it's included. This is kind of, in that part of advice, monitoring and reporting is included in the price of the product afterwards.
Any more questions? Yep, there's one.
Hi, my name is Meriton Ibrahimi from EY. I'm interested in the implementation of the robo-advisor. So Professor Condy-Fresnik talked about that you have to not only consider the spending, but also the income, meaning if it's more bond-like or equity-like. So how far does your robo-advisor take that into consideration?
Yes, I guess I'll take that question.
Yeah, sure.
Is the okay? Yeah. Yes, for now, this is the way we tackled the dynamic long-term optimal control problem. What it really is, right? Is in a setting where we have the bank's products on the asset side, right? So we have 5 different investment strategies in the respective currencies, of course, that are the investment space. So of course that's sort of a simplified investment space, but this is really what the bank can offer, right? On the cash flow side, what we've decided for now is that we've considered them as certain. So as you saw, what we model in a probabilistic sense is the goals which we'd like to achieve, like building the house. What we must achieve, like financing the children's education, is a certain cash flow and has hence no stochastic process attached to it. The same thing we do for the financial income and or the savings you saw. So typically you might even have a holistic financial planning that goes ahead of this, and what results from it is, you know, the delta in terms of income and spending, so your savings rate, and that we take also as deterministic in this setting.
Thank you. Are there more questions? We have plenty of time.
Hello, my name is Adrian Bosser from Ecofin Investment Consulting. I have one question for Mr. Wies. So I would be curious if you also consider, you were talking about the probability to achieve a target, and I'm curious if you're also considering other or second risk measures, because with the probability to achieve the target, you basically ignore everything that happens if you do not achieve the target.
Yes, it's a very good point. And of course, if you only focus on this simplistic objective function, like maximize probability of achieving the function, it might become very digital, especially at the end. So you become really risk averse once you're a bit above the target, and you're very risk seeking once you're a bit below. So here we employ, of course, also drawdown penalties, which imply some smoothing in the end. So the goal is that the algorithm becomes something intuitive, right? So on a systematic basis, we want to achieve very intuitive results, right? And that's the overarching goal, such that we can guarantee that the advice is of the same high quality, no matter what advisor you get and how good he slept just last night or not. You want to have, in a systematic way, a high quality advice, and hence the algorithm needs to perform and output also intuitive results. And the way of achieving this is, of course, you introduce drawdown penalties to get this intuitive smoothing, especially towards the end of the goal.
Question to Mr. Strebel from the Cantonal Bank. You talked about how much effort you expect in educating the clients in affluent and in private banking. How is your experience with educating the client advisors within the bank in using this process?
Well, that is, I'd say that's a second phase or a second generation. As I said, we try to implement goal-based investing somehow, or addressing goals more explicitly. And that has somehow failed, because obviously, I mean, the client advisor, they realized, okay, I can do that, but I cannot kind of translate it into real advisory value with my clients. And of course, there was resistant to some degree, or they didn't, simply they do not do it. That is a matter of fact. With that, I think what we can argue is the art of client advisory still stays with the client advisor, but we have something in place that is as objective as possible. So if you want to bring in more emotions and your special knowledge and experience, that is all good, but you have something aside that is as objective as possible, and I think that is also makes it, to my view, also clear that whatever you do it's not worse than what you have done before. It can only be better or even. Because you have something on the table that brings out, or that excludes emotion. It's statistics, stochastics, of course, expectations, etc., but already processed in an intuitive way. And you, on top, of course, you bring in all the art of client advisory that our client advisors and all viewers probably claim that they have those skills. I think it's a good combination because it's not a competition anymore. You have a base that is objective and you add a human touch on it.
One more question, yes, please. So.
Thank you. My question is directed to anyone and all of you. So it seems to me that a common feature of your presentation has been to take the goals as given. You know, they come from the clients. But goals do change. For example, Mr. Schribbel, you gave the example of an investor reaching his goals earlier than expected because of successful investment performance. What is the role of the banks or the advisors in shaping the goals of the clients and therefore not taking them as exogenous, but rather helping to define the goals?
I think this is what I meant with art of advisory. I think robots and machines can much better find out the optimal portfolio. That is not rocket science. I mean, if you don't need humans to do so. Machines can do that much better and much faster. But the art of advice is actually to unveil the wishes and the goals of clients and to translate it in quantifiable numbers. I think that is the art, and probably also the most difficult one. I remember when I was as a client, clients don't like to be kind of really, well, determined, fixed, and get kind of, they want to have the flexibility, etc. And this is something you have to accept. Not every client will be probably willing to enter in this concept by telling you, I want to reach that level, etc. In the tool, we haven't seen that. We have some kind of diversions to the core model that clients also can tell you, I want to have a minimum number of return, for example. That comes close to people telling, yeah, I just want to have more than inflation, blah, blah, blah. This kind of inputs. Of course, we divert a bit from the model. It gets closer to traditional portfolio, but it's important that you can capture those wishes or requirements from clients in the same tool. That you don't have, okay, you have fixed goals, do that. If you have more generic or not a clear idea what you want, okay, then we do totally different things. I think that wouldn't be sensitive in the area we are active.
Yeah, I think if I may add to that, I mean, in the case that you described before, if you reach your goal early, that's a beautiful case, right? Because then the bank can show will help you achieve your goals. And I think a second part is also that the tool helps you to really explore what's possible and what not, right? Maybe you see that maybe you don't need as much money as you originally thought because Takeaway offers such wonderful investment products to achieve your goals, or the other way around. You realize maybe not all of my goals are realistic. So I think you get into a conversation with the client advisors at the level where you start talking about the goals, right? And exploring ideas. And that's also where the dashboard was designed in that way, that you really have a sort of a possible landscape of portfolio of goals, right? And you can really get into that type of conversation. And of course, in the end, traditional goals like target return goals, target risk goals, they're just a subset of the dynamic strategies, right? The static is always a subset of the dynamic. So of course, that is achievable as well.
Okay, if there are no more questions, the last one for today, for this panel, I mean.
My name is Arno Endres, Luzerner Kantonalbank. I just wanted to ask Mr. Wies, I think, what projections do you use to calculate the probabilities? Is it based on historic data, or do you alter the expectations for the returns of the different asset classes given the environment. For example, for the bond, for Swiss bonds, you could probably not use the historic returns from the last 10 years.
Absolutely, and it's a very good point. I guess there's two sides to calculating probabilities, right? One thing is the risk model, right? You have to have a forward-looking risk model to estimate how correlated are your strategies, what's the expected volatilities around them, etc. And the other side, as you mentioned correctly, is your long-term, medium-term, short-term return forecast. So here we operate in the traditional framework, how we typically operate with the banks that we implement our tools with, where we at Swissquant, we're very experienced on the risk side. So we do the risk calculation, forecasting of the risk, where we're very successful, and we leave the return side to the banks and take as input the expected returns that the bank has on the different investment strategies over the different horizons. Of course, you need to differentiate a little bit whether you have a 1-year expected return for bonds or your 30-year plan. But that's typically in the expertise of the banks who have their own research and can provide us this input into the tool.
Thank you very much. Did you want to add something? Sorry.
I think that is pretty correct, because, and I think that is also a difference to what that application to what is usually done in banks. They just apply one expected return, whatever is 5 years or 10 years, just an average, and this leads to totally wrong conclusions for short-term investor or very long-term investor. So you need to resolve somehow in a simple way the problem that people have, even people have different time horizons because they have different goals, and you have to solve that and also take into account the reality of markets and bond markets. I mean, it's an extreme, and if you don't tackle this, and I think many banks don't do this, they have, I think, strange assumptions for bonds in their models. I think that is critical to address those issues these days under the special circumstances we have nowadays. Yeah.
Thank you very much. I'd like to thank the speakers, Pierre Colin Dufresne, Matthias Wies of Kant Group, and David Strebel from Thurgauer Kantonalbank. Thank you very much.